Hello guys, welcome, and sorry Brent for not playing you any tunes in the chat leading up to this. In the Discord some guys were asking because what happened to the music, because there was music usually in the waiting list or in the waiting sort of screen, and there isn't today, because I'm trying to figure out how to not get copyright claims on the videos. But I think you can get like a license for Monster Cat, which means that you guys will be stuck with EDM music, which isn't the worst thing in the whole world. In any case, welcome back. Thank you for joining for yet another installment of the saga that is learning how to trade. Currently, we are going to work through a number of, the plan is to work through a whole vast array of stuff, but we're currently focusing on sort of the building blocks of technical analysis, and then from there we'll build onto stuff a bit more, look at more strategy type stuff from there. To give some perspective as well, some of these videos leading up to this one are, they're all pretty amateurish still, but they'll get better. So what I might do is or what I plan to do at least, is make highlight ones, because some of these videos are very long, 1-2 hours, that kind of thing. And I am thinking of doing sort of more concise versions of them. So do a 15-minute sort of wrap up or summary or whatever the case is. That might be a bit easier for you guys to watch than to sit through these very long ones. In any case, while I have you for the long ones, and the live ones is obviously where the most value is to be created. At least that is the vision for it, because ideally you can interact on the chat, both on YouTube or on the Discord. The link is below to join the Discord. There is a Discord channel that everyone can join for free. And we can chat and share charts and look at stuff there, and obviously the idea is to learn as much as we can and support each other, and really just allow learning to dictate how, because knowledge is power, and we need to share knowledge amongst one another so that we may all be empowered to become better traders. So alrighty, I'm going to sort of jump right into it. Today we are going to kind of continue where we left off last time. Last time we had a look at moving averages, simple and exponential moving averages, and how to calculate those. And then we also looked at some of the sort of oscillators that go around that. So there was the MACD, which is the moving average convergence divergence, which is basically a momentum indicator derived from moving averages, measuring the distance between those moving averages, and so on, and how we then interpret that. And we looked at how we calculate that so that we can understand how we then interpret that to understand what it's really telling us. We also looked at the RSI, or the relative strength index, and we ran through the calculations of that. And then both of these indicators we then used to look whether or not the buy and sell signals that they generate would have been successful in the past. So what we're going to be looking at tonight is three different oscillators, or three different indicators that we're going to be looking at. One is the stochastic oscillator, then there is an indicator called on-balance volume, and then there is average true range. So we will look at how they are sort of calculated. We will then look at how they are applied and what they tell us, and then hopefully we don't go for 400,000 hours again tonight, and we can look at some of your charts in the end of the period. So let's jump right in. First of all, before we start going, questions. Any questions? It seems there are none so far, so I'm just going to get going straight up. Starting with the stochastic oscillator. The stochastic oscillator was developed by a gentleman called George C. Lane in the late 1950s. So this was before the computer age. Many of these things, back in those days, people would draw charts literally by hand, by reading the open, high, low, and closes, or just the closing prices for the day, or whatever the case was. And they would from there build charts and indicators and all sorts of stuff. So it was very maths driven at that stage, and you would have to work this stuff out yourself. So today obviously we have software that does that for us, which makes life a lot easier, but it is still very helpful to understand how these things are calculated so that we have a better understanding of what they really tell us, because a lot of the people a lot of people out there just look at the indicators, or the gurus will tell you, or if the indicator does this, that, and the other, you need to buy or sell. And often, sometimes that is true, sometimes that is not. We have to first understand what actually the indicator is telling us before we can make an informed decision on what the what we have to do around the potential signals that indicator gives. So okay, starting with the stochastic oscillator again. George C. Lane made it in the 1950s. It is a momentum oscillator and or indicator, and what it tries to do is it plots the location of the closing price relative to the high and low range over a set number of periods. Okay, it follows momentum of price movement, and momentum changes. Well, okay, so I'll start with point 3. What it does is it looks at where the closing price is in comparison to the high low of the previous trading day, right? Or over a number of trading days. So later on we look at the average of 14 trading days, or the highest and lowest of periods, or the highest and lowest points of an average, over a 14-day period, and we look at where the current close is in relation to that, so that we can see, and then we measure that change over time, and then we can use that to interpret momentum, right? So it follows the momentum of price movements, or the speed at which price moves. If price is moving up really high, the stochastic will rise. If price is if price is moving up really quickly, stochastic will rise. If price is moving up really slowly, stochastic might not have such a steep slope on it. So, and the general sort of theorem here is that momentum changes direction before the price movement does. So if you think about a ball you throw into the air, it sort of accelerates up as it leaves your hand and then slows down, and I'm going out of the frame here, slows down, and then eventually comes down and accelerates on the way down again, right? So we think that, or the theorem here is that stock prices do the same. They initially sort of trend up really strong, the momentum runs out, starts to wane, the momentum slows down, and then eventually the direction changes. So what we're doing is we're measuring that momentum, and we're trying to see when that momentum starts to slow down so that we can then forecast the price change. And this is why when stochastic oscillators in particular, when using them in particular, divergence is a very important part. So basically, George Lane, when developing this, said that there are basically only 2 ways in which you can use that could give you signals to buy or sell, or to enter into transactions on the back of a stochastic oscillator, and that would be looking at divergences between the momentum of the stock and the price of the stock, and also then looking at what's called a percentage D line. So we'll get over there. So let's look at the calculation of this thing. What we're going to do is so there's a couple of things, and this is a bit, I'm going to try and explain this as best as I can, so bear with me. Percentage K is the actual value of the stochastic oscillator that we're going to plot, and percentage D is sort of the moving average on that, okay? So if you remember with the RSI and with the MACD, there is the RSI and then a signal line, or the MACD line and then a signal line. So here we have the stochastic line and then a signal line. So that stochastic line in this case is the percentage K, and the signal line is the percentage D. Now, the percentage D is a very simple 3-day simple moving average of K. All right, and percentage K we calculate by looking at the current closing price less the lowest low over the period that we're looking at, or the look back period is what it's called. Actually, there is something called that look back period, is the number of periods that you look back. So we're looking at the current low price less the lowest value in the look back period divided by the highest price minus the lowest low both in the look back period times by 100, right? That is the stochastic calculation. So it's really fairly simple. The lowest low is the lowest low for the whole period. The highest high is the highest high for the whole period. Usually it's 14 days. And percentage K is then multiplied by 100 to give us 2 decimal points. Otherwise, we're going to get 0.95 or 0.26 or whatever the case is. And just to be able to plot it nicely, we multiply it by 100. So there is a difference between a fast stochastic and a slow stochastic. You will find on your trading platform that, or some trading platforms have the option for both. Basically, a fast stochastic is the calculation we've just explained, and the look back period it uses the look back period, at a 3 day, it's supposed to be, and a 3-day simple moving average, right? A slow stochastic smooths that percentage K line by 3 days, right? And then adds another 3-day simple moving average on there. So basically, in essence, a slow stochastic is the percentage D line of a fast stochastic with, that value is then the percentage K line in the slow stochastic because you slow it down by 3 days. And then on top of that, you put another 3-day moving average. So let's have a look at how these are calculated. I'm going to bring, all right. Me, I have problem. I don't have problem. Left screen. Okay, so there we have some stock prices. We have open, high, low. Hello, Dash Slyblad. Hello, Peter de Toy. Thank you for joining us. Sorry, I see the Discord chat stuff. Obviously, I don't look at the YouTube analytics thing as much as I look at the Discord. So if it takes me a little while to respond to you on YouTube, there, or if you've commented on YouTube, then that's why. But yeah, okay. So looking at the sheet that we have open here, these are. Yeah, I didn't plot the high, low, close data. So I've got high and low data, and I've got close data, but only from 14 days onwards. So the first 13 days of closing data is missing, and then of course the opening data is missing as well. If the share price looks familiar, this is in fact the actual high, low, and close data for the stock Sibanye Gold over the last 30 days, right? So what we can see here on day one is the high was 10 Rand 30, the low was 9 Rand 50, and we've got all this data, right? So what we do here is we isolate over a 14-day period, because these are the standard settings. It's 14.33 is usually the setting. So 14 is the look back period. 3 is the 3-day moving average that we apply to get the percentage D, or our signal line, right? And then if we add another 3, then that is when we slow it down by we put another 3-day moving average on to get to the slow stochastic. So, and I'll show you the difference between the two in a second. So let's just do this calculation, right? So when looking for the highest high in Excel, it's very easy. You can put in a formula max. So we type here equals max. Oh, let's just delete this. You can type here equals max, and then you take this entire sort of 14-day, take this entire 14-day period, and then you close it up, right? So what it's going to do is it's going to go look for the maximum value in that period. The lowest low, we are looking at for 14 days as well. We are going to do the exact same equation here. We're going to say equals the minimum value of this entire period. Why is it so sticks? The minimum value of that entire period there, and kapow, that gives us 9 Rand 50. Okay? From here, it's a very simple calculation. We just take these two fields and we drag them down. And it gives us the highest point. For looking back 14 days, this is the highest price. Looking back the next 14 days, it now cuts out that day, and it includes the newest day, and it will work out the highest low, or will indicate to us the highest price and the lowest price during that period. To calculate our actual stochastic value, or the percentage K, we are going to use that formula that we just looked at, which is over here. So we're going to use this formula here, right? By basically wrong buttons here. By basically working out this thing. So what we are going to do, I'm going to delete it just so that you can see for illustrative purposes how this whole thing works. Okay, so percentage K, we are going to use, we're going to say equals the current closing price. Oh, first we need to open a bracket. Open a bracket. We're going to say the current closing price minus the lowest low for the past 14 days, right? Divided by the highest high minus the lowest low, close the bracket, multiply that by 100, bang. And there's our value. Comes to 95.808, okay? So we'll run that equation again. We are looking at the current closing price, in this case is 12 Rand 90 per share. Sorry, I keep doing it. Oh yeah, 12 Rand 90 per share, minus the lowest low during that period, which now has changed from 9 Rand 50 to 9 Rand 90, right? Divided by the highest high during that period, 14 Rand 24, minus the lowest low, 9 Rand 20. Close the bracket and multiply it by 100 so that we get, like, you know, an actual number, not just a decimal, and bang, there you have the stochastic for that thing, and you can just sort of fill the formula on the way down. Then what we need to do is we need to now work out the percentage D line, or the moving average, or 3-day simple moving average on this, and that is very easy because we just say that is an average of these 3 days, bang, right? And we pull up that all the way down, and there we now have our trigger line, if you will, that we have on your stochastic oscillator. This is the calculation basically of a fast stochastic, right? If you use a slow stochastic, which is kind of the one that I prefer to use, all you do is you take this percentage D line, right, that you've worked out here, which is a 3-day moving average of your percentage K line, and you basically work that out as another 3-day simple moving average by putting a 3-day simple moving average on that, and and then running that down. So it's a very simple calculation, right? But basically what you can do is you're taking where is the current closing price in relation to the highest and lowest points it's been over the last 14 days. And then depending on how close, what we're doing is we're measuring how close the current low is to the high, or in relation to the high or the low over the past sort of period, right? Let me just pause here for a second and find out if there are any questions up to this point. Hey, Cameron. Hey, nice. Glad to see you watching, dude. So do we have any questions at this point? Please feel free to ask. It doesn't seem so, but I'll give you a little bit of time. So, okay. There are basically 3 types of signals that we can use, or that we can use stochastics for, or 3 different things that we can use with them. We can trade the crossovers between the percentage D and the percentage K line. So this is much like a MACD indicator, where you have the MACD line and the signal line. Here we have a stochastic line being the percentage K, and a signal line being the percentage D. When these cross over, those are our triggers, right? Likewise to a RSI indicator, we can use overbought and oversold levels, and we can use breaches of particular set levels on those levels. So it oscillates between 0 and 100, and it's just how it works out. The maths, it will never go above 100. It'll never go below 0. So, you know, it's very convenient. And then basically what happens is we can trade breaks upwards below 20 up, or down from above 80 down. We can trade those breaks, or you can trade obviously divergence between momentum, higher highs, higher lows, or whatever it is on the stochastic oscillator, and we can trade that versus the price, or we can do a combination of all 3 of those signals. So I just quickly want to do the following so that we can have a look at this. Back. All right, so here we have Sibanye Gold, the share price that we had calculated or looked at sort of from kind of this period here into here, right? And this is the stochastic oscillator that we had calculated. Just trying to see how far off my calculations are. Yeah, not that bad. So, okay. Basically what we have here is, this is a slow stochastic that we have on here. So I've changed the colors a bit so that it looks easier to see and stuff. So if we work out a fast stochastic, this is what it looks like. All right. I'm going to make it a little bit bigger so that you can see. I've got the green line here, which is the stochastic line, and the red line, which is the trigger line, or the percentage D line, okay? And you can see it has these crossover periods, right? It ranges sort of between 0 and 100, right? and then in here is marked the 80 and the 20 level. So a move up, anything below 20 is oversold, and a move up, or let me move that across. Anything below 20 is oversold, and a move up from below 20 through that sort of 20 level could be considered overbought into, from an overbought position, it could be a buy signal, right? And a move from the overbought position above 80 and a move down into that could be potential sell signal. And then you see that there is a crossover. When these cross over, your percentage D line crosses over your percentage K line, or let's just call it the signal line. There's a crossover between the signal line and the stochastic line. That is a sell signal, and likewise it is a buy signal. But we can also see that this is a relatively messy and very sort of spiky, thing. It's not. It might give a couple of false signals here. There's a false signal. There's a false signal. So it's not necessarily as easy to read. So what you do, or what you then do, is this is a fast stochastic. So what you can then do is you can slow it down to smooth it out a little bit, and then you smooth K by 3 days, right? Or not 13 days, by 3 days. So basically you're doing just that extended calculation that we're doing now, and you're replacing the percentage K line with essentially the percentage D line, and then putting a moving average on the percentage D line, and then you end up with a stochastic that is a lot smoother as the one is that you look at now. So just to show you the difference between that again, if that is 1, then you have your fast stochastic. If that is 3, then you have your slow stochastic, right? It's a lot smoother. And then this just gives a much smoother kind of ride. And now you can see that your signal quality is slightly better when there's a sort of a crossover of the signal and the trigger line, or the signal and the stochastic line. It's a much better quality signal than it was before, because these crossovers are a lot smoother. And again, you have the overbought and oversold territories that the stock could trade in. So what you could do is, instead of using just these types of things in isolation, you can use them all together. I wonder if I want to quickly see if I, because obviously I did close it, and didn't. Anyway, in the Discord, there is a, let me just show you here, this document. Right, so this is our divergence document, if you remember, right? So we looked at normal divergence, normal bullish and bearish divergence, and hidden or reverse bullish and bearish divergence. So you would use this as a reference point to hunt for divergence. So what you would ultimately want to do is look for a combination of all 3 of these things at the same time. So you would like to see some sort of divergence at play, as well as a signal line, stochastic line crossover from an oversold position coming into a upward momentum position would be like the ultimate setup for us, right? So if we look at this particular chart, there is actually a very nice example. Obviously, looking back in history is way easier than spotting these things in going forward, but such is the nature of technical analysis, I guess. So there we have higher highs, right? We're going to make that nice and thick, and we're going to make it that sexy pink. And here we have lower highs, right? So there we have, according to our stochastic thing, we have what is deemed regular, normal, bearish divergence. And we have a slight meltdown. So that is a sell signal from an overbought position down from above 80 down below. So you have that overbought oversold trigger, and you have a moving average crossover or a percentage D crossover from your over your stochastic line, and you've got bearish divergence, and you could have a potentially good short trade from, let's say, about there until you see maybe a crossover there again, which would be a buy signal, or just a complete reversal of all of this and a closeout position there. Or you could be a bit more pragmatic and hunt for a previous support level and maybe try and take the money when you get to here. But that actually worked as a fairly good signal, right? At the same time, let's look for some more. Let's look for another example. I'm just doing this on the fly, guys. If you want me to look at your charts while doing this, please give me suggestions. Tell me in the Discord. If you have charts you want to look at or use as sort of real life examples of this, and we can hunt for the stuff together, then that would be awesome, actually. So let's say that we've got all these lows, and we've got that. That does not constitute as divergence to me, so that does not count. But nonetheless, it seems as though that if we have these sort of movements up from below the 20 level up through 20 with a sort of crossover, that's always going to happen, I guess, at these turning points. It does seem to be quite a nice buying signal. Let's look if we have sort of longer term divergence here, because those look like higher lows to me, right? And these look like lower lows to me. So that is slightly longer term bullish divergence, and then we have this sort of combination of things here. So I think that could have been potentially a nice buy signal. You might not have seen it there. You may have tried to get it on one of these pullbacks, or this pullback perhaps, or even this one would have been a nice, because it sort of comes down and tests at this little support level just above 20, around 25 level here. If you remember, we looked at the RSI, how you can look at support and resistance levels on the actual indicator itself as well. So it looks like it's a fairly accurate and reliable indicator, actually, I would say. I'm just going to go back to the left screen so that I can check any YouTube questions. How many oscillators do you suggest using, Mohammed? Mass real estate. Okay, let's have a look. MAS, what's the ticker for mass real estate? I've never in my entire life looked at mass real estate. Or even heard of it, to tell you the truth. But the number of oscillators I would suggest to use is probably, I don't know, probably 2 or 3. I mean, I wouldn't use more than that. There's a saying that says analysis paralysis when you look at just too many things. So I tend to look at ATR. I tend to look at stochastic, slow stochastic. Sometimes, well, basically the 5 that we have covered by now, or will have covered by the end of this, are usually good ones. You don't have to use them all in conjunction, because then you can't really see the price of the bloody instrument either, which is relatively important to, it's like the most important thing to look at. So it really depends on you. But yeah, I mean, 2, 3, maybe it's worth looking at all of them before making a trading decision. But remember that they all tell you something different, and they are all independent sources of data, and they tell you different things. And if you start model building, which is something that we're going to get to much later, you can start giving them weightings in a larger model. So you say that you've got a bullish buy signals and stuff on a stochastic, and you've got bearish signals on a MACD, and you've got bullish signals on this, and you give each one of them a weighting in a bigger model, and then that gives you a momentum based or a whatever technical based buy or sell, and then you combine that with like a trend based something, or you buy and you combine that with a fundamental thing, and then you start building like a universe of things you want to be long and short. But that we get to at a later stage. Right now we are going to talk about on balance volume. So on balance volume, I'm not going to do a little spreadsheet for this. This is really a super easy one to work out. Basically, I'll run through the same sort of format as before. It was developed by a dude called Joe Granville in 1963. What it does is it measures buying and selling pressure. So when the market trades up for the day, when the previous close, today's closing price is higher than yesterday's closing price, it takes today's trading volume and it adds it to yesterday's trading, or it adds it to the cumulative trading volume, and it plots a point. If today's price is lower than yesterday, then it takes today's volume and it subtracts it from this cumulative number. And it has no top or bottom. It's a cumulative indicator. It has no caps or floors on its value, so it can keep going in one direction for a very long time. And it has a number of applications as well. Obviously, we look for divergence and stuff, but it sort of indicates what I've written there is positive and negative volume flow. So the idea really is to see on the days that the market is moving higher, it's moving so. Okay, I need to actually show you a chart to explain this. Basically, what we use it for is to confirm price trends, as well as look for divergence in changes of momentum. So, to explain to you how the calculation works, if the closing price is above the prior close or above yesterday's close, then it takes today's volume plus the current value of whatever the on-balance volume is. If the closing price is below the previous closing price, we've done this, current day's volume minus the previous value of the OBV, and if the prices are the same, then it's equal. Okay, so let's look at this. We're going to first delete our sexy little things. I'm just going to go to the left screen so that I can see if there are comments. MSP. Center. Nash Real Estate Inc. Ta-da! Alright, so we're going to remove the stochastic and we're going to add OBV, on balance volume. What a boyki. And this is really ugly to see, so we're going to make it green. Nah. Purple? Nah, green. We're going to make it green. We're going to make it thick. So what this shows us, as you can see here, something happened here. So there was a massive amount of shares that were traded on this day, like a colossal amount. So alright, weaknesses of on-balance volume. Volume spikes can distort our lovely indicator. So we can see here there is a colossal spike in volume. Our average volume traded here, I mean, I don't want to say what the average volume is, but it's looking like somewhere around 18,200, 2,000, 1,900, right? Obviously times 1,000. On this day, we traded like 2,000. Oh, sorry, I'm totally lying to you. So we're trading 500k shares a day, 500k, 500k, 700k, 500k, and then this one fine day we trade 147 million. Wow. Okay, so that's a significant spike. So that is going to distort our data. So what we can do to keep the data poor is cut it off, right? And look at only a limited amount of data. Or perhaps what we do is we move to a 1 hour time frame, because then we can look at more time and we don't have to. Oh, you see there again, another volume spike, and it distorts our data, right? So let's look at 1 day and we just basically start from here. So what this is doing is it shows us that on the days that the market moves up, right, whether or not volume is moving in the same direction. I think that this stock is a little illiquid actually, because we're trading 180,000 shares a day, 500,000, it's a little less. So let's do something that has very consistently got the same volume. I hate to use Nasdaq, but it's Nasdaq. Or First Strand is very liquid. It's a very nice stock also. So what we can look for here is when we we know how this works, right? So what we're looking for is we're looking for it to either confirm trend or bring potential warning signs for trend reversals, right? So in this case, we can see that price is moving higher and the OBV is moving higher. Price is kind of not really moving much, but OBV is picking up. So most of the time what this is showing me now is that on the days that the price is moving up, volume is bigger than on the days that the price is moving down. So that shows me that there is general buying interest in the stock. And if we look at how where did I put Discord? If we put it how our oscillators work, if we've got higher highs, on our indicator and lower highs on our, but we don't have lower highs, well, sort of lower highs, because those could be considered the same. So this could be a potentially bearish, but it's a bit difficult to tell. So let's see if we can find something that's a bit more trending. So this is, I think, to answer your question from earlier, Mohammed, is like, you can see that sometimes it's not very obvious what the answer is, so, or what the indicator is trying to tell you on a particular stock. So then it's not applicable. Then you want to use something different. What has been trending really, really nicely? I'm trying to think of just a stock that hasn't had an absolute massacre on it in the last while. I mean, Vodacom, we always tend to look at the same stocks. So okay, but what we can do here is you can see that this kind of trend here, and this stopped me out. I tried to short this. It's very unfortunate. But here we've got sort of a higher moving thing, and we've got lower highs here. So this is kind of sort of a bearish signal. These are lower highs. Those are lower highs, and these are all higher highs. Well, that's a very ugly looking picture, but that's kind of the idea, right? So that is a bit of divergence, and that may have led to, well, this is all fundamental stuff, I guess, but it kind of starts to show that idea that we don't have, that there's a bit of divergence. In this case, we can see the price coming down, and you can see how the OBV, or the on-balance volume, is kind of trading in lockstep with that, or not trading, but measuring volume. So on-balance volume is coming down in this downward trend, because on the days that the price comes down, more volume is being traded lower. So that's a very nice indicator of, confirmation of a trend. So I think what you want to see is you want to see price moving in the same direction as OBV, and then there's sustainability to that trend. If you see price and OBV moving in the opposite direction, then well, maybe there's not sustainability in that particular trend. So let's have a look. Any other questions? Where is the Discord? I'm gonna move that away. Okay. Falling wedge. What are you looking at? Stochastic. Okay, let's have a look at this. Sorry, I'm just looking at one of the Discord things. And I'm going to look at this somewhere with you for the first time. The text is a bit small here. There it says falling wedge, and looking at stochastic, we overbought. Okay, sure. You got 533 and not 1433, and you are looking at a daily chart. So sure, okay, you can change the stochastic to 533, but remember that the guy who developed this developed it with 14 days. You're using only 5 days, so yours is way more sensitive and will respond a lot faster than what mine would, for example. But okay, so rather in this case, wait for bullish divergence in an oversold position. So you're wanting to go long, but yes, basically, yeah. So you're waiting for a pullback. You're waiting for bullish divergence in an oversold position. So you want stochastic to come down to oversold. Look for bullish divergence when that happens, and then when you've got that move back up to 20, then you follow the trend, and then you play out this falling wedge. Is what I'm guessing the plan is here. So I'm going to look at I don't know what Stochastic's TSH. All right, so I'm going to leave the on-balance volume there so that we can actually just, I don't know, mess with it, I guess. Stochastic. Yeah, these standard settings are random. Hey? There's no like. So look, I'm using 1433, so that's slow stochastic. We're just going to make these bigger so we can see them. We're going to go green, and red is fine. We're going to not highlight the background. Okay, so your wedge is here, I think is what you've drawn in, right? Something like that, right? I just want to see Discord. Oh no, okay, sorry, yeah, hang on. My bad. You're looking more at like that, right? So now if we look at, I mean, the differences are very slight, okay? So your stochastic here sort of bounces off twice, spikes all the way through 50, then back down to oversold, then back up, right? And then you've got this movement here. Our data providers are obviously different because my charts look a little different to yours. Or actually you've just got better accesses set up than I do because I've got too many bloody indicators. And then let's have a look here. And then you see that mine doesn't do that little bounce. Mine only gives a little bloop, but it doesn't quite break it. And then also in an oversold position, yours just got reacted to it a lot quicker and was a bit more sensitive. So again, as with the MACD stuff and the RSI stuff, this is very, very customizable, and you can use it. You can mess around with the settings and such as you please, because every single person is going to have a different way of using it, and a different stock is going to have a different response to it, and whatever the case, right? All right, so the last sort of conceptual one that we want to get to tonight is average true range. So average true range was developed by J. Wallace Wilder. I don't know how to say that first name. Wallace. Sorry, I'm going to have a sip of coffee. I forget that I have it. In 1978. So actually it wasn't developed in 1978, and the same must be said with on-balance volume. It wasn't developed in 1963. It was first published in 1963, and the same with Wilder first publishing the use of this thing in 1978. This is again back before there was computerized trading and this kind of stuff that we're using to do charting with today. So all these things were done by hand every day. Coffee sippy time. Please submit questions in this time. So the purpose of average true range is to measure volatility, not direction, not momentum, not indicate which direction the stock might go, only volatility. Okay. There are two parts to calculating average true range, and that is first to calculate the true range. Once you have the true range, you can put an average on that, right? I just want to see something here. All right. So first we must, and again, as per usual, I think as the space, 14 days is very popular because it's basically 3 weeks in trading days. So it is, 5 days a week. You've got 1 day short of 3 full trading days. 3 full trading days is also like about half a month. So back then, I don't know why everyone used 14, but everyone used 14. And again, what we're working out here is what is the true range of the stock on any given day, and then looking at at a look back period of 14 days and calculating the average of those 14 days, what the range is that the stock are traded in. So there are 3 different ways in order to calculate true range. One, basically, is the current highs less the current lows. Right? So today's the high price is 10, the low price is 8, the difference is 2. All right? So that is the true range on the day. Method 2 is the current high less the previous close, or method 3 is the current low less the previous close to give you an absolute value, right? Both of these give you an absolute value. The reason is the true range can't be negative. So you have to kind of wangle it in such a way that you come out at a positive number. So what you're basically doing, and I've actually got a couple of like examples and stuff here that I've pulled off, and long explanations, but basically what you're doing is you're looking for the furthest distance away from the previous close, and you're measuring that, right? So if there is All right. Okay. So this is what this average true range is working up to, Peter, because what we want to do. Sorry, question in Discord if you haven't seen it. The question is, how can ATR be used as a method to calculate trading stop loss? So this is a topic for another day. Not necessarily a topic for another day, but it's like a much longer explanation. If you start becoming dynamic and you're responsive and you change your stop loss every day, you can change your stop loss every day based on ATR. And there's like a whole methodology. I did it in one of the power hours. Actually, it is in one of the power hours, and it is on one of the like, what do you call it, playlists on the channel. So have a look at one of the power hours. I think it's the third one that I did. There's an explanation of how to do that. It's pretty worth it. I'll get to it later as well. In any case, so to calculate this, basically, I mean, I'm going to ignore all the stuff on the left here. Basically, you're looking for the previous day's closing price, and you're looking for the furthest point away from that closing price. So if the market gapped up, then you're using the high of today minus the close of yesterday. If the market gapped down, you're using the lowest price minus the close of yesterday. If you have like an inside day or whatever the case, where you have the today's entire trading range swallowed up inside yesterday's trading range, then you just look for the furthest point away from the previous closing price, and that is your true range, right? So to then illustrate that on to you on a calculation basis, you have to now ignore that spreadsheet and probably that one too. So much of spreadsheets, and basically look at this little bad boy we have over here. Okay, so here we have this is actual data from, I think, I don't know, somewhere on the index, I'm not 100% sure, from like 2010, right? So we have high, low, close data. And what we're doing here is we are looking at the difference between the high and the low. So we're figuring out what the difference is between the high and the low, and we are calculating that and plotting it, right? So to get to ATR, let me say this also, it works the same as like an RSI. You need to have as much historical data as possible, at least 250 data points for it to be any kind of accurate. You know, the more ideally you'd like for it to start on the first day that the stock was ever listed, you know. So maybe as an exercise in you know, becoming a real analyst, write down all the data, price data that multi-choice group generated today. You know, open, high, low, close, it's there. With those 4 data points, pretty much all of this stuff that we've calculated in technical analysis is calculated, right? So okay, we are looking at the difference between the high and the low, and we work that out. So we just basically say here equals the high price minus the low price, and pa-pow. Very easy, right? So for the sake of simplicity, we calculate that all the way down, right? So now on the days where the stock is you know, gaps up, we want the furthest point away from the previous close. On the stock stays the gaps down, we want the furthest point away from the previous close. So what we do is we rather just calculate then the difference between, so we're using now this method 2, method 3 thing that we looked at over here, where we say, remember there's 3 methods of calculating it, right? So method 2 is the current high less the previous close absolute value, right? So in our Excel sheet, what that looks like is you put ABS for absolute value. Look, you put absolute value so that you have a positive, and you're looking at your current high price for this day minus your previous day's close, right? And that gives you a value. And the third method to do this is the current low less the previous day's close, which gives you an absolute value as well, right? So the current low price less, oh wait, no, sorry, first we must put ABS to give us an absolute value. We can't have negatives. The current low price minus the previous day's closing price. Bang. Right? And that gives us basically three different numbers. Now what we do to work out the average true range, or the true range is the biggest out of all of these, because that is the true range. The largest number out of these three different methods to calculate the true range on a day is what the actual true range is. So then we just use that calculation or function where we, in Excel again, where we say, give us the max out of these three numbers, and it will return that particular number, right? And we just run that calculation basically down all the three ways. And you can see here, marked in green, there are situations where you know, on the 12th of April here, 0.26 was the biggest number, and that gets pulled through to true range. 0.6 here was the biggest number, and it was method 2, and that gets pulled through here. Method 3, and that gets pulled through. And that is basically just on allowing the market. So the idea here that the indicator was developed by a guy who was trading commodities. And commodities would often limit up or limit down and not trade the whole day, because they would stop the market from you know, moving too much in any particular given day. If you think about how corn futures or wheat futures contracts in South Africa trade, they trade only for like 3 or 4 hours a day, and if they move more than, you know, a certain percentage, bang, that's it. 5 minutes into the day, the day is closed. So you had to somehow, you know, looking at just the highs and lows on those days wasn't actually a fair reflection of what the volatility is. So that's why you had to compare the highs and lows with the previous day's closing price to capture that volatility that is not being expressed in today's high-low movement, because today's high-low movement is limited by market limitations, you know, limit up, limit down. And this is particularly true in stuff like commodities, and not so much equities. Obviously, we can apply this to equities, and that's why we then use, you know, this is where it comes from. So in any case, so we work out then what the maximum value is out of these three different methodologies, and that represents our true range on an everyday basis. And then once we have 14 data points, we can then basically just do another average calculation and say we want the average of the previous 14 days the average of the previous 14 days true range data, and kapow, that gives us that, and we then calculate it from there. Now what this guy wanted to do, Wilder wanted to do, and I actually never put this in the slide, was to smooth out, oh I did, you see, because I'm clever. He wanted to smooth out this data much like they did with the ATR. I mean, not with the ATR, with the RSI, right? So once you have your first point, which is 14 days average, he then wanted to have this rolling average, so that you don't look at just the average of the total range over the last 4 days, but you start looking at an average of the average true range, right? So you have the same effect as that you do on something like the RSI. So the current ATR, so the equation is thus: the current ATR is equal to the prior ATR times 13 plus the current ATR divided by 14, right? So you multiply the previous 14-day ATR by 13, you add the most recent day, and then you divide that by 14. So to show you what that looks like, we are doing this calculation, right? You take the previous day's ATR, and you're multiplying it by 13, you're adding today's total range, and you're dividing it by 14, right? So you take the previous day's ATR, or I need brackets, I never have brackets. You take the previous day's ATR, you times it by 13, right? You then add today's ATR, and you divide it by 14. Bang. Ah, no. Got the wrong things here. And you divide it by 14. So you take yesterday's, you multiply it by 13, you add today's total range, and you divide it by 14. Bang. And that gives us this calculation. And then basically what we're doing is we're smoothing out that ATR number, and then that basically plots this pretty line, and we're going to keep using Taste Holdings here. I'm just going to remove all our annotations, and we look at ATR, right? Now it's red. It's so random. Bang. And there we have the average true range. So what this is actually showing us, and this is to your point, Peter, or to your question that you asked a little while ago. What this is actually showing us is what is the average true range of this thing? How volatile is this stock? So how much can we expect this stock to move on any given day, right? What is, over the last 14 days, what is the average way that the stock has been moving, right? So as we can see here, and I just need to see my own little screen. I'm going to zoom in a bit. As we can see with our average true range being plotted at the bottom here, this reading here, this is for today's price data on Taste Holdings, or TSS, Stochastic, not Taste, Stochastic, right? The average here is 92.6199, so call it 93 cents. So on average, the range in which this stock trades on any given day is 92 cents. So, and that is kind of what we can expect. So when you enter into a trade, for example, on a stock, you can use the average true range as an indication of how volatile the stock is and where you should place your stop loss. So the thinking here is that if I can expect this stock to move 93 cents in one day on average, then my stop loss can't be less than 93 cents away, because then a normal day's worth of movement is going to stop me out of the trade. So I might get a situation where there's a risk reward ratio of, like, you know, let's say you're using this support level here, right? And you want to enter on 20 bucks, and you want to stop out at 1980, right? 20 cents risk. And you're trading for the top of the range here for R2, right? So you've got 1 to 10 risk reward. I mean, that's a fantastic trade. Yeah, okay, cool. You can try and put that on. But the problem is that on any given day at this period, the stock is expected to move 97, 98 cents as a daily range. So giving the stock only 20 cents trading range doesn't make sense, because it's only like 1/5 of the average range that the stock goes. So the stock can go 1/5 of its normal daily range against you, and it takes you out of the trade. So it lowers your probability of success. So what you could do is you can then, for example, enter into a trade and say, like a trailing stop loss methodology in this case is then to use an ATR times 2, right? So you see what the ATR is in this case. Most recently on Stochastic, it is 93, right? We said. So 92.6199. You multiply that by 2, so that gives you 186. So it's R1.86. So if you enter into the stock, your stop loss can trail the closing price by R1.86. You know, and you would adjust that then every day. That is one way of using a trailing stop loss on an ATR. This actually, an ATR times 2 trailing stop loss is actually like my favorite thing in the world to use. I'll show you where to find it if you want to do a bit more detail on it. Hey Joshua, thanks for subscribing. Lots of parrot videos. So here, playlists. There is the Power Hour videos, right? I think it is the third one that I did. Those are really cool. Obviously I did these in conjunction with the Just One Lab. Shout out, yo! This one, I think, I'm now literally going to show you at some point. There is a very cool explanation on how trailing stop losses work, and this is based on the ATR times 2 methodology. So go look at this video. At some point I'm going to get back to this, and I'm going to do this stuff in more detail probably than I did here. It is important, I think, for people to obviously understand the mathematics behind these things. So Peter, I hope that helps. Then that, ladies and gentlemen, is the sum of the content that I wanted to cover this evening. So if you have any charts that you would like us to look at, please do so, and I will be happy to look at it. And I know that you probably don't want to look at that, so I'm going to put that up. So if there are any charts you want to look at, any questions that you might have, because that pretty much covers our content for the evening. ATR, yeah, memes, trading memes. You know, gaming memes is a thing. We need to start trading memes because there are some, but they're terrible. Anyway, yeah, so that's that. Fluit my story is 8. I'll give it a couple of minutes if you guys have some questions, and or any feedback. Otherwise, I hope that you have enjoyed it. To give shout outs to the new guys, David Walker has joined the Discord. Slavmaster Shribes has joined the Discord as well. So welcome, guys. Please, there is offline chat. If you guys have like stuff that you want to look at, throw your charts in, start talking to each other. Use it. It is there for you to be used. I'm just going to quickly look at if there are any more questions, and it seems there are none. So that's it, guys. I made it. 1 hour. Ha! So the plan is from here probably to do some summary stuff so that we can keep the long explanations and the going through examples and actually doing the maths on the spreadsheets. And I mean, obviously the nature of these will change over time as the content changes. And then I'll do like little summary stuff that's maybe a little easier for people to consume in shorter periods of time, 15 minutes or whatever. Otherwise, I hope that you have enjoyed, and I hope to see you again next week. And that's it for me. So yeah, see you in the Discord.